Hello, everyone. Bull or Bear 2023. Welcome to show 6 of today's series and kicking off December, the 1st of December, as we head into the new year. We're covering navigating the uncertainty, reasons for optimism today. I'm your host, Olivia Higgins, and as usual, it's a pleasure having you join us on this show, not just to engage in the discussion, but to take it as a learning experience and journey for you, because it's all about educational content over here. And we really pride ourselves in being the bridge, the access to experts on site, and really people that we work with on a daily basis to uncover the latest industry trends and also market trends going into the new year 2023. Now, the path forward continues to look a bit opaque, right? And, the past few days, we covered a range of different topics, different industries. And so today we're going into more of an outlook perspective, trying to navigate the uncertain markets out there. And most importantly, what are the key opportunities, the possible ones that you might want to look out for with the heightened volatility during these times. So with that, I would like to introduce our expert for today from Wellington Management. We've got investment strategist, Jeremy Butterworth. Hi, Jeremy.
Hi, Olivia. Thank you so much for having me. It's a pleasure to be here.
Thank you so much for joining our show. Now, the audience is always ready with your questions, but for everyone who's out there, take this as an educational experience, but leave your questions towards the end because we want you to be a part of the discussion with Jeremy. Now, Jeremy, just to start off, the topic for today, especially for those who just joined, navigating the uncertainty, reasons for optimism. The word optimism and uncertainty, what do you have to say about that?
Yeah, it's an interesting sort of title for the presentation because I think we're in a period of really peak uncertainty. But as we look through the noise, there's different factors there's definitely a lot of factors that drive us to have optimism for equity markets, for returns as we look into 2023.
Right. And maybe you could tell me a little bit more about yourself because, we've had you before on the show, and this is, I think, your second time, right? Being on the live show.
Yeah, I'm a returning guest, so it's fantastic to be back.
That's maybe hopefully one day.
I'll tell you a little bit about my background. So as an investment strategist at Wellington, I sit in a fairly unique position. My role sits at the intersection of our portfolio managers, our global industry analysts, our industry experts, our macro strategists, our geopolitical strategists, and our end clients. And so, my role is really to process this wealth of information internally, understand how individual specialist teams are thinking and articulate those views to our clients and really, bring to life what I would characterize as the best thoughts across Wellington's platform and, help clients understand what are the challenges that markets are facing, but really, looking through that noise, how they should be thinking about a framework for investing.
Right. So I understand you've got some insights to share with us and also, just a short visual aid for the audience as well as part of our discussion. So let's go straight to it. So perhaps you could tell me a bit more on the general outlook from Wellington Management and how, we can navigate uncertainty right now.
Yeah, so I think the first point is to really understand, what has been driving markets this year. And potentially we could just start on slide 3 if you don't mind. I would say to say the least, this year, the market has had a myopic focus. There's been one factor that has been driving returns, has been driving the profound impact on our lives, on the breadth and ability for central banks to be able to respond, and broader economic conditions. And that factor is inflation. And to put this into context, looking at the chart that you can see, inflation really has been benign for close to 2 decades. So it's not a factor that central bankers, that us as society has really have to deal with. And so, in a year like 2022, where in some parts of the world you're seeing double-digit inflation, close to 10% in the US, it has had a profound impact on markets. And so, I just think about the cost of rent, of mortgage repayments, of feeding our families, and even just, the most basic thing, getting a taxi. All of these have gone up meaningfully. And so, I guess the question mark is, this has been somewhat of a perfect storm, I think. And so, there's a culmination of factors that have driven this level of inflation. You've had the hangover of COVID impacts, so supply chains being disrupted. You've had geopolitical challenges with Russia's invasion of the Ukraine, China and US tensions, impact on sort of Taiwan semiconductor markets, and broader knock-on effects. And so, the question mark is, as we look into 2023, will this persist or abate? And so, we've done a lot of research around this. And so, I'll talk you through how we've sort of come to the conclusion that actually there should be a level of optimism for 2023 when it comes to inflation. It's our view that you should see a moderation in inflation, and really inflation falling over 2023, especially in the US. The macro strategist I deal with most closely, Juhi, who's our US specialist, her view is that we could see inflation at sort of sub 4% by the end of 2023. So let's dive into how we've drawn this conclusion. If we just want to move forward to the next slide, I'll talk a little bit. There's three factors you want to think about when it comes to inflation. It's supply chains, it's energy prices, and it's wage inflation. And so, when I think about supply chains, on the first chart you have here is really around inventory. And, through 2021, as economies opened up, supply chains were still very distressed. You couldn't get access to PlayStation 5s, to semiconductors, to new cars. I'll give you a story. I bought a bicycle in January 2022 from Germany, and it was going to take 5 months to be delivered. I could literally fly there and pick it up and return it and bring it back faster than it would take to ship it over. I looked just over the weekend. That same bicycle would take 5 weeks. So the disruption in supply chains are definitely starting to ease. And you're seeing that in the chart here with inventory to sales ratios picking up. So the amount of inventory on hand at shops, at retailers, has started to increase meaningfully. The other aspect to think about, if we flick to the next slide, is looking at this in a slightly different way, and that's just the supply chain index. And so the dark blue line here shows you that supply chains continue to ease over the course of 2022. Again, another factor that's going to help the moderation of inflationary pressures, mitigating that supply and demand dynamic. And then finally, one other way of looking at this is the cost of shipping. So if you're shipping something from say Shanghai to LA, if you just look at slide 6, you can see that the cost of that has dropped dramatically. And so, late 2021 and into 2022, you had hundreds of ships sitting outside of ports in LA that had cargo that they couldn't get off. And so that also had meaningful impacts on supply chains and this supply and demand dynamic. So all of these factors are beginning to ease or continuing to ease, and we foresee this continuing to happen over the rest of this year and into 2023. So these are all positives. The next thing to think about is energy. And so, when I think about energy prices, if we just look at slide 7, the really interesting point that there's really two key takeaways. I'm just on slide 7. And the first one is that different parts of the world are facing the energy crisis more or less acutely. And this chart really gives you the biggest drastic example of that. So this is the price of natural gas in Europe versus the price of natural gas in the US. And you could see in 2020, they were basically sitting on top of each other. Now, Europe has had a very acute issue with accessing energy, and natural gas being a key one. So again, this tells us that there's going to be greater dispersion in countries and different parts of the world's ability to mitigate inflationary pressures and the energy crisis. The second factor to remember, and really the more acute one, and I think the profound one, is the fact that energy prices are still falling dramatically from their highs. So we're not seeing $130 oil anymore. Energy for European gas peaked at $100. It's now, closer to 50. And actually, as I look forward, a key metric to look at is how much storage has been filled up in terms of European liquid natural gas. And today, they're at about 95%. So, the Europeans aren't going cold this winter. The final factor just to look at is the rig count. How many new rigs are being put on? And because that's going to have an impact on new supply coming on as well. And, it does have a lagging factor in terms of new rigs coming on. But what you can see here is the dark blue line is that the rigs have picked up meaningfully. And so, again, another factor sort of, being a tailwind to mitigating some of those inflationary pressures. Now, finally, wage inflation. So if we just look at slide 9, it's important to think about sort of where we are in terms of wage inflation. This has had a meaningful impact on inflationary pressures, the ability to access, high quality labor and bring them into your company. And so, the point we're at today is we're at record unemployment, multi-generational lows. And, when I compare that to forward-looking employment expectations, which is the light blue line, and this is an inverted chart, so it's a little bit technical, but basically, look at the news. If it's Facebook, is it Google, Microsoft? Every large company around the world today are really rethinking about their forward-looking employment intentions, and this shows us that those intentions have mitigated significantly. Companies either have hiring freezes or they're reducing headcount. Facebook, for example, Meta, are reducing 11,000 employees, 13% of their workforce. So these are meaningful impacts on the employment perspective. And so, that's going to have an impact on wage price inflation and the ability to negotiate, higher wage prices, and really should help sort of, again, balance out some of that supply and demand dynamic.
Mm-hmm. Thank you, Jeremy, for highlighting the key drivers in the current market situation and also opening the discussion about inflation. So we've talked about inflation, that it is easing, but what about, the impact on markets and equities in particular this year, and any specific observations that you'd like to share with us?
Yeah, it's a great question. So I think there's really two key observations. And if we just want to move forward to slide 10, I can talk you through these. The first one is that this year has been an incredibly challenging year to be invested, not only in risk assets, but intermediate risk and traditional, more low risk assets like bonds and fixed income. There really has been nowhere to hide. So if we could just move one slide forward, please. And you can see this on this chart here. Whether you're in developed market equities, emerging market equities, small cap, value growth, you've experienced a negative return. The one place you could have held and hidden is in energy and commodities. And so, historically, we've seen a lower investment in this space over the last decade, partially for ESG reasons, but also because of the forward-looking returns for some of these businesses. And so, this has really been a challenging year for investors. The other aspect to think about is, if we look at slide 12, really the divergence in returns as well. So, this is a really interesting chart. So within global equities, you have a number of styles of investing. You can invest in value-orientated companies, so traditional low price to book, low PE companies, or you have an option to invest in quality or growth companies. And growth are usually higher PE, higher octane businesses, and you pay a higher price for that growth. In 2022, we have seen one of the greatest divergences in history, over the last 20 plus years, in returns between growth and value. So style has been a meaningful impact on generating, better or worse returns. To put this into perspective, the MSCI All Country World Growth Index versus the MSCI All Country World Value Index The difference in performance is 22%. 22%. And so for the statisticians in the room, this is a 3 standard deviation move. We are out in the tails. So, as I look forward and I think about, forward-looking returns generation, there is going to be an element of mean reversion here. And so, we do think that style is important, but also, having flexibility in your portfolio across factors like style will be extremely important in generating returns.
So, Jeremy, would you say, in terms of market cycles, after analyzing the market, could you just please share your view, perhaps, and insights about the market cycle? And also, to extend beyond that, what kind of cycle do you think we are in right now, and where are we going?
Yes, this is a really great question and very insightful, Olivia. So, firstly, I would say when I think about where we are in the cycle and what has changed, what's driven returns over the last, 10 or 20 years, and what's going to drive returns over the next 20 years, I think it's going to be quite different. So if we just look at slide 14, I think we're going to be in an environment of structurally higher inflation, greater dispersion, dispersion between geographies, dispersion between industries and companies. And with that, this is actually an excellent place for active management. So having a manager that has flexibility, that has nimbleness, is going to generate outsized returns. Having optionality in your portfolio is really important. But to bring it back to where we are in the economic cycle and really sort of trying to give the audience some context. So we've been in environments where, the economic cycle has continued to tick down. It's continued to contract. And what you see on the screen is actually a Wellington proprietary index that looks at 7 forward-looking and current economic indicators. And what's really important about this chart is that it has a high probability or high prospective view of where the market is going. So it's forward-looking by around 2 to 3 months. And the other aspect is it has a very high correlation, 0.6, with the MSCI All World Performance. So, as this cycle is ticking down, you usually see the MSCI All Country World, performance starting to fall as well. Now, what's really important to remember, the audience, is that as we look forward, it's our view that we should see this economic cycle, the global cycle index, bottoming over the next 3 to 6 months, and then starting to inflect back up. Driven by a number of our forward-looking indicators. And so, when I think about sort of investing today and sort of the headwinds and the uncertainty, actually, starting to think about sort of dollar cost averaging, starting to think about allocation to risk assets could be very, very interesting in terms of, being ahead of where the economy is starting to shift to. With that, though, if we look at slide 15 and back to my key point, the regime shift that we're moving into, this is just a chart of global quantitative easing, and you can see how drastic the removal of quantitative easing is, and that's going to have a profound effect on markets. We're no longer in a period of free money, of a low cost of capital for equity or broadly investors generally. And coming back to that point, that's going to drive greater dispersion between industries. Different countries, different companies that have better pricing power, better ability to face the challenges of inflation, of other broader pressures, are going to be in a better position. And so us as active investors with our deep research platform really are able to identify the best places to allocate capital, and we're going to be extremely flexible in how we do that. We're going to build optionality into our portfolios, and ultimately I think investors want to think about the total return in your portfolio, how much is coming from growth and how much is coming from income. And, income is something that you can definitely, eat and bank at the end of each quarter or whenever it's paid. And I think that's extremely important. So the next thing is to think about, on a forward-looking basis, where are we today, and how should I think about valuations? How should I think about, earnings and profit margins? And if we just look at slide 16, we can see here that valuations actually come down meaningfully, especially in the US. if I look at US valuations, they peaked at close to 40 times. And so, I'm looking at the cyclically adjusted price earnings ratios. That's quite a technical term. But really the key takeaway is that the KPEs, again, have a fairly strong predictive power for forward-looking returns. And so the lower the PE on a current basis, the better the forward-looking returns. And so today we're sitting at just over 25 times. This chart actually only goes to June, but up until the end of October, we're sitting at just over 25 times. So that's very close to where we were in March 2020. And that was an excellent time to be thinking about risk assets and in particular US equities. So today we think valuations are much more compelling to think about allocating to risk assets. The next question is valuation. Is earnings revisions. You've got one side of the coin of how much am I paying for earnings, but how much more potentially are they going to come down? And I think this is one we have to be somewhat conscious of because, it's our view that earnings have come down and the revisions have continued to broaden, but there still is the capacity for another leg down in terms of revisions as we enter 2023 and recessionary pressures become a little bit more profound. And so something that I think, again, there's going to be greater dispersion. You want to own high quality businesses, ones that have pricing power, ones that have a tangible moat, that are participating in secular growth stories. Finally, profit margins. So if we just look at the next slide, it's important to think about, what is the profit that these companies are generating? Is it still appealing? And again, the one point I want to highlight is that the US continues to be a very, very profitable place for businesses. And you can see the chart on the right-hand side of this slide, and it shows the differential between MSCI World profit margins and US MSCI profit margins. So again, our view is that US excellence, should continue. They've also, entered the interest rate cycle earlier than many other economies, and they're starting to see it dissipate faster than many other economies. So that's a few views on where we sit today.
Thank you, Jeremy, for highlighting that. And I think those are key essential points, especially about the cycles and also the performance of the different markets. And we've already got a few questions on this, but we will leave it till the end. Everybody wants to ask Jeremy questions, which is great. So keep being a part of the discussion. We will pick out the best questions to ask Jeremy towards the end. Okay, so with what was being said, Jeremy, let's look at the state of a few characteristics that the market is focused on right now. And also, do you think now is a good time about, buying risk assets and in particular equities? What do you think about that?
Yeah, it's a great question. And I think it is a challenging one. If we look at slide 23, I sort of want to frame where we are today. Because we are in an environment of, I think, frankly, peak uncertainty. And there is an element of a regime shift happening. And as I noted before, what drove equity returns the last decade, I think, could be very different in the next decade. I said greater dispersion between countries, between companies, between industries. Pricing power is important, and higher cost of capital and lower access to monetary stimulus are going to all have profound effects on markets. The flip side as well, I would say, is that end investors now have an option. We're in a period of what I characterize as TINA. There is no alternative. You had to buy risk assets. You had to stretch to generate a meaningful level of return. I've coined a new phrase. I call it Cindy. Credit is now delivering yield. And the first point of credit is really bank deposits. And, I've spoken to many clients, and, you can receive, 5% plus in a US dollar deposit these days. And so, I think it's important to balance your portfolio in terms of where your returns are coming from, what ballast you have. But again, I think you want to own, inflationary protecting assets as well. Growing your wealth isn't going to happen just in bank deposits. When inflation is at 7.5% and you're getting 5% on a bank deposit, you're still receiving a negative real return. And, that's not something that we've had to deal with in the past. And so looking at this chart, this gives you, a framework for thinking about, which assets to own in different economic environments. And so we are in a period of elevated inflation, but potentially falling in inflation, and potentially, a slowing economic environment. And so I do think, high quality equities are a very interesting space to be. High quality income where you're generating a higher yield than your cost of capital or inflationary pressures. So yields of 7, 8, 9%, I think, are really compelling. But then also, inflationary protection as well. And so, again, this is a period where I think investors want a manager or a strategy that's going to have optionality, nimbleness and flexibility because of this uncertainty. We're going to move around these economic regimes, I think, more and more over the coming few years. And so having that core flexibility, leaving it to your manager to be able to, move your portfolio around and capitalize on these opportunities, but protect your capital at the same time and generate a compelling level of income, I think really is where I would be thinking about allocating to.
Thank you, Jeremy, for that. Okay, so I know there's a lot of information being shared. So maybe in your previous slide, right, is there anything in particular that the audience should pay attention to if they were to prioritize?
Yeah, so I mean, I think there's 4 things that you really want to remember when it comes to, the framework that we're thinking about and thinking about investing today. If you just want to flip to the next slide, this may be helpful just to see it visually, but I think the first thing is flexibility. You want flexibility in your strategy, the ability to own bonds, to own equities, have different tools to generate income. I think, those types of strategies are going to be very well placed.
Right.
Secondly, high quality fixed income. Today, fixed income is yielding you a very compelling return.
Absolutely.
And, as we look into 2023, it's going to provide ballast to your portfolio. If we move into a slowing economic cycle, duration is actually going to be really meaningful, and it's going to generate outsized returns. It's been very painful this year, but next year, I think it's actually going to be the one thing you really want to have owned. The final piece is really inflation and income. You want a level of inflationary protection. We're not going back to sub 2% inflation periods. We're going to be in a period of 3 to 4% inflation for the foreseeable future. So having inflationary protection, whether that's high quality equities that have pricing power, whether it's other assets that are real assets, it's important. And then finally, income. You really have to think about the total return that your investment is providing, and a consistent and steady level of income is something that you can bank each month or each quarter.
Right. Well, Jeremy, thanks for sharing that perspective. And, the key point you mentioned was flexibility, and also, really zoning into the spaces that are not just hot right now, but are also generating the yields that people are looking for, right? So as you mentioned, going back to the cycles, right? Cycles are back, and they're, they may be more frequent and violent. So, under the current market environment, especially with uncertainty, what would you say is the preferable way to seek stable income while effectively managing the downside risk?
Yeah, that's a great question, and I think it really comes down to thinking about a strategy that has both bonds and equities, but also additional tools to generate that consistent and stable income. And so through some of the Wellington strategies, how we think about it is how do we generate a compelling level of return? How do we mitigate some of those, the volatility, the big swings of equity markets? Taking just equity beta can be a wild ride. And so how do we sort of, mitigate some of that volatility, but generate consistent income? So, I think you want a strategy that can provide flexibility across asset classes, but also think more intuitively about income generation. And, option strategies are actually a really interesting way. So covered call strategies where you're collecting a coupon whilst you own a really cool company, an interesting business that has pricing power, but it increases the yield that you're getting and enhances the income stream that you're getting.
Thank you for sharing that. So I guess, after what you've shared, I do want to, there was a lot of information, which is great. And we've got a lot of seasoned investors as well watching, they love the technicalities that you used. And of course, we've also got a good mix of, people who just want to know general outlook based on your perspective. So thank you once again for sharing your insights. But just to end off, before we go into a chat between the two of us, what would you say is that key takeaway or summary point you would like to end off with?
Yeah, I would say, as I think about 2023, again, I think a lot of investors have felt, a decent amount of shell shock and pain because of returns on both sides of their portfolio in 2022. But I think you do have to have a level of optimism and really, if you're going to allocate capital in 2023, it comes to that point that you said, flexibility. Have flexibility built into your portfolio. Have optionality built into your portfolio. Have a core manager that's going to allow you to move around the field. I often think about, your portfolio as like a soccer team, and different managers play different roles.
Right. Very good timing with the World Cup.
Exactly. Yeah. and so, yeah, it really, you think about having flexibility, think about having, someone who can be a defender as well as a striker at the same time.
Of course, we all love a good striker and a good defender. So really good analogy right there. I love it. And I'm sure the audience appreciated that as well. Okay, so, based on what you shared, I've got just a few follow-up questions for you. Okay, so, you talked about also the indexes, right? So the major indexes were showing negative returns year to date. So what do you think the impact was on the markets? And could you share your observations on what to look out for just generally for 2023?
Yeah, so I mean, it doesn't matter really which index you've looked at around the world, whether it's the S&P 500, the S&P 500, the MSCI World, the Asia Index like the CSI 300, or closer to home for me, the ASX 200. All of these indexes are down on a year-to-date basis. What's interesting is the composition of these indexes around the world are all quite different as well. Take the Australian index. It's predominantly bank and mining companies, and so whilst it has slightly outperformed things like the S&P 500 and the Dow Jones and the Nasdaq, it's still down significantly. When I think about 2023 and equity indices, I would really take a step back and think this isn't about buying beta. This is an environment where dispersion is going to be elevated. And so, you should really think about, which businesses, which companies do I think have pricing power, who have consistent secular demand? Which businesses have a meaningful moat? How important are they to our daily lives? Are we going to continue to use Netflix if it goes up by $2 a month? Are we still going to take our kids to Disneyland each year if the price of park admission is X instead of Y? Are we going to continue to use Microsoft software? And I think, we have to think about, what is the secular changes that are occurring in the economy and what's driving that change, and which businesses are at the epicenter, the catalyst for that change? Because those are the businesses that are going to continue to have very consistent, very reliable earnings. Those are the businesses that are going to grow their revenues meaningfully over the coming years. And those are the businesses that are going to be rewarded by the market. I think we are going back to a period of fundamentals. In over the last decade, you've had companies where they haven't generated any revenue. They've had access to significant amounts of cheap capital, and the higher the price to earnings you were trading at, the more you were rewarded by the market. The further out your own earnings, the more you were being rewarded by the market. I think that's changing. I think as we look into 2023, investors' appreciation for durability and stability in earnings is only going to increase.
Very comprehensive. Thanks for sharing that. Okay, so what do you think then going forward? What is the trajectory for rate hikes from here onwards?
Yeah, it's a great question. Actually, I think we've got a slide for this in the deck as well. Let me just quickly check. Slide 19. Yeah. So when I think about rate hikes, and I'll focus more on the US, but this year, I think the Fed has been somewhat behind the market in terms of where the trajectory of rate hikes were going. And progressively, we saw the market shifting its views in terms of the terminal rate for US fund rates. And so, what you have here is what we saw in July versus what we saw in September. And today it's actually even higher. So the terminal rate for rates in the US, could be around sort of 5 to 5.5%. And we're circa at 4% today for Fed funds. And I think this is important because, the first point is that I think interest rates, next year, should see themselves starting to top, and you're seeing that in the chart here. But also, I think investors have this view that you should see interest rate cuts next year as well. And I think, at Wellington, we have more of a contrarian view here. We do think rates are going to be higher for longer. And so, there's going to be a point where central banks, shift from their myopic focus on trying to bring inflation down to their focus on trying to support economic growth. And their willingness to think about inflation being structurally higher over a longer term period. But really, I think this is going to be healthy for risk assets. Having a higher cost of capital, a higher risk-free rate, means that the overall returns for equities on a forward-looking basis, and we've seen the repricing of equities today, should be more positive over the coming years, and especially in the back half of 2023.
Right. And I liked how you gave, two perspectives with that, also looking at the opportunities after we went through, there's a lot of uncertainty, but there's also, a lot of skepticism, right, out there. So thanks for highlighting also the reasons for optimism, back to the topic of today. So my next question, what are your thoughts on fixed income? Because you mentioned that towards the end of your discussion with me just now. So what is that insight related to fixed income as an allocation today versus 12 months ago?
Yeah, and it really comes back to my point that I made in the presentation from Tina to Cindy. Credit is now delivering yield, and so investors have an alternative. You are being compensated, extremely well right now in fixed income markets, and you don't have to reach for considerably to generate a meaningful return. You can buy investment grade bonds that yield you, anything from 5 to 6 to 6.5% quite comfortably. And so, I do think that fixed income actually, today versus 12 months ago, where, it was, sub 3%, the appeal of fixed income is considerably higher today. And the optimism I have is the fact of the ballast that it can provide portfolios. So if we, and we do think the base case is that we have, a slowing economic environment, in that type of environment, owning longer duration bonds is actually going to be beneficial to your portfolio because of the duration impact. And so duration has been painful owning this year, but in 2023, I do think it's going to help generate some better returns in the fixed income part of your portfolio. So owning high quality bonds, I think, is a legitimately smart decision to think about as we move into 2023.
Well, just an extended to that, based on fixed income, we covered some discussion topics in the past few days about also Asian bonds, right? So do you have any views related to this within Asia and how it's positioned globally right now within the fixed income space?
Yeah, it's an interesting question, and I think I should qualify what I'm referring to when I think about fixed income. Predominantly, what I was referring to was higher quality US and global fixed income. So think about Microsoft. Think about sort of large corporates like Nestle, Google that are issuing fixed income bonds. Asia is its own beast, I would say, in terms of fixed income markets. And in particular, I think where investors have been focused or had a captive audience is in Asian high yield. And that has been a market that has been extremely challenging over the last 18 months to 2 years, predominantly driven by the Chinese high yield property market.
Right.
And so, we do think there have been some implementations from the government that are, more promising for the outlook for Chinese real estate. But this isn't an area where we have a high conviction in terms of, purchasing some of this debt. And again, our view is that you don't need a reach, you don't need a stretch to buy distressed credit to generate a yield today. You can comfortably take a little bit of risk and generate a compelling return that's going to give you inflationary protection, that's going to give you a compelling income, but also ballast to your portfolio in a slowing economic environment.
Thank you, Jeremy. To end off our chat before we go into the live Q&A and also a short demo. And remember, audience, we're doing some giveaways today to also reward you, but also test your knowledge of what Jeremy just shared. So, Jeremy, just to end off, what do you think about, focusing on income versus growth versus value investing in 2023? A very popular question.
Yeah. I think this is like the $1 million question. Do you continue to stay in the value bandwagon, or do you shift and put a bit of capital in growth, and where does income sit in between? I think the first thing to think about is that the income that you can get today is fairly compelling across asset classes. Whether it's high quality equities that are more dividend orientated, whether it's through, options trading strategies where you're doing covered calls and you're clipping the coupon of writing options over your portfolio, or whether it's more broadly in high quality fixed income. So we do, I would have a preference to focusing on a more consistent, reliable income in this type of environment, given the level of uncertainty and the breadth of opportunities for the path forward. The range of outcomes is still very wide. And so making a specific bet in value versus growth, I think, could potentially end investors in a slightly more challenged position. And so that really comes back to that point of flexibility. Investing in a strategy where the manager can be active for you, leave it to the chef, if you will, the omakase approach. And
I love it.
A manager that has that ability to think about growth, think about value, and shift the portfolio around actively, I think is really important. And so it's not about buying one or the other. If I had to choose one, I would actually be more overweight growth as I came into 2023. And that's because we do believe there's going to be a bottoming in the economic cycle. I do think that companies that can outgrow the broader market are going to start to be rewarded. And really just even thinking about the technicals. So, the fact that the differential between value and growth is so wide that there should be a level of mean reversion in terms of the shift back to growth.
Right. The omakase approach. I love the analogies you're throwing out for this show today. And of course, it's also quite memorable for the audience listening. So, very important points about flexibility, about, giving that, that power as well, and trust. Right? Trust to credible people that will help manage for you. So to end off, thank you so much for being a part of this chat. We'll be back with you shortly, Jeremy, for some live Q&A questions that I've already started to pick out. But before we go into that, we'll go into our first giveaway. We'll see you soon, Jeremy.
Fantastic. Thank you very much.
Thank you. So to the audience watching, I hope you enjoyed that. Some key insights there. If you want to watch the replay, and if you joined halfway and missed out some points, don't worry, you can replay anytime after this show. But with that, I would like to reward you for being here with us. And I hope you've been taking your notes, because this question is related to what Jeremy just shared. Are you ready for the first question? Now, before we go into the first question, just for the new people that just joined us, the first 5 people who get the question right and answer as quick as they can, so fastest fingers first, will walk away with a giveaway from our teams to you. Are you ready for the first question? In 3, 2, 1. What was the unemployment rate in the US in October 2022? Is it A, 3.7%, or B, 7.3%? What do you think? Yeah, you guys are very fast. You're always very, very quick. All right, we've got our winners, our top 5 winners. Congratulations. The answer was A. You'll walk away with a giveaway prize from us. The teams will be in contact. Okay, so you've learned the insights. Now, how exactly can you apply what you just learned from Wellington Management today? We had Jeremy on the line with us. And of course, there were a lot of key comprehensive points that I really hope that you managed to digest and learn. So if you open your app, follow me through right now. It's going to be very straightforward. And if you're interested, do take a look, because these are practical steps you can take forward after this live show. So you open your app, it should look like this. Yeah. Go to trade on the bottom, go to Money Plus, and on the right-hand corner, you'll see fund houses. You click on fund houses and you'll see all the available fund houses that we have on the Moomoo platform. And if you scroll down to the bottom right-hand corner, you should see Wellington Management right there. Okay, so for the purpose of today, we're going to use Wellington Management, of course. So if you click on Wellington Management, you'll see the number of funds related to this particular fund house. So you can choose and decide which one you'd like to go for. Now, for the purpose of today, let's try for Wellington Multi-Asset High Income Fund. So click on that, and you can see the live data related to this, okay? So this is important because, you know, I personally like to customize, and I like to change my time horizon accordingly. So I think, you know, for yourself, it's really a personal choice. Whatever you want to focus on, we provide the tools, we provide the instruments for you to make that decision for yourselves, okay? So if I were to just scroll across to the different tabs, you've got performance, and of course, you've got the net asset value, the NAV that you want to track, the percentages, the yields, and also the different performance indicators that you need for yourself. You go to comments, you can see what the communities are saying about it. And of course, news and analysis. Now, analysis is one component that I would like you to take away from this short demo. You can get access to the documents, you know, the fund managers, who's actually active on that portfolio right now. So all these are tools, again, to give you that whole picture about the fund and how you can actually take it a step further from what you learned today. And if you're interested, you can click on subscribe, the bright orange on the bottom right there. Click on subscribe and it should come up like this, okay? So if the fund is something you're after, you just input a minimum of 100 Singapore dollars from your universal account, and you can click on subscribe to just once you make your decision about the fund that you'd like to subscribe to. So I hope that was helpful for you. Now, this is very short, but it's just a quick way for you to access the fund. If you have more questions, don't worry. We've got an email towards the end, and we've also got the team on site right now in the chat rooms for us to track and see what you want to know about this particular component. So if you have any more questions, just write it in and the teams will take note of that so that they can get back to you as soon as they can. Okay? All right. Thanks for listening. Now for quiz number 2, I'm going to go straight into the second giveaway for today. Are you ready? Fastest fingers first, and you've got to get it right. We'll award the top 5 people. In 3, 2, 1, quiz number 2. Which of the following metrics is more widely used to evaluate a company's financial health? A, asset turnover, B, free cash flow, or C, operating margin? What do you think? Pretty straightforward. Let's go. A, B, or C? Yeah, you guys are very quick. Congratulations to all 5 winners. The teams will be in touch as soon as they can for the prize that you walked away with for answering this question correctly and also fast. Okay, with that, and before we go into the final giveaway towards the end, we will go into our live Q&A with Jeremy. May I invite Jeremy back onto the floor, please?
Thanks, Olivia. Here, ready to go.
We're ready. We've got so many questions for you, but I'll pick the top 5 or 6. Okay.
Sure.
So, Jeremy, the first question, someone would like to know, now that the Fed is easing the rate hikes as early as this month, what do you think about the imminent of the recession coming, and do you foresee a soft or hard landing for next year?
Yeah, it's a nuanced question, and I think we kind of need to take a step back as well and think about so the Fed. There's rhetoric that the trajectory of rate hikes may be slightly lower, so we're going from 75 to a 50 basis point hike. But I wouldn't use the word easing. We're still in a tightening cycle, and I think we're going to see that into the first quarter of next year. And so I think when I think about that in relation to the economic environment and recessionary pressures, it's our view that, we will continue to see a slowdown in broader economies, especially in the US, and a recession. But in saying that, it's our base case right now that it will be a shallow and it won't be protracted and deep. And so, that's why I've sort of alluded to the point that when we look at the global cycle index, it's our view that will bottom over the next 3 to 6 months and then inflect back up. So, whilst we will be, in a slowing economic environment and a mild recession, this isn't going to be, a very deep and dark and protracted period.
Thank you. So next question, Jeremy, you mentioned that unemployment is at peak. So which sectors do you think that unemployment is worst and least hit? And what does that mean for an investor next year?
Yeah, so when I was talking about unemployment, I was referring to the point that we're at, multi-generation lows in terms of unemployment. So the chart that you saw on the screen was unemployment in the US, and so that unemployment rate is sub 4%, actually 3.7 as of October, for all those fast fingers answering the question. And so when I think about unemployment across industries, it's interesting. One of the areas, where I think we will see is heightened unemployment, and what's going to have a greater impact on wage inflation is in the skilled part of the workforce. So think about engineers that work for Facebook, engineers that work for software and IT companies, people that work for Amazon, and some of these broader large conglomerate businesses. And so again, the fact is that we will see an inflection and an uptick in unemployment across a number of industries, as the economy slows. But this is a healthy level of movement in unemployment. We don't foresee that unemployment is going to be back at 7, 8, 9, or 10% across the globe. And so that's really going to help dissipate, the wage price inflation pressures, and again, bring down overall inflation.
Mm-hmm. Next question, what are your views about funds and cash fund, money market fund? Should we stay away if, the yield potentials change as Fed rate hikes are easing for next year?
Yeah, it's a great question. I think that's the opportunity cost. Do you invest in a term deposit where you're locking up your money and you have challenges with reinvestment risk? Do you invest in a money market fund where you've got 3-month bills, and you're trying to beat cash slightly? Or do you invest in sort of longer dated fixed income assets? And so, my view is that actually, I think you want to be more interested in longer dated fixed income assets as we move into 2023. Again, we still have a number of rate hikes to occur, but I guess it's really trying to pick your spot in terms of owning some of these assets. And it's the one thing I want to leave in all of our clients with is the fact that timing markets are extremely difficult, and rarely do investors get that correct, consecutively well. So, I think you have to take a prudent approach to how you're allocating your assets, and dollar cost averaging, building an asset allocation plan and sticking to it is really the best way of generating, outsized returns and meaningful wealth creation over time.
Important point there, but asset allocation. Okay, so next question. You mentioned flexibility in investments and having different income sources. Now, what do you recommend in terms of different income sources, and are they stable and lower risk as compared to the others?
Yeah, so when I was thinking about sort of, income sources, diversity in income, really thinking about where is the most compelling income across asset classes, and having differentiated income sources was really, not just relying on the dividends of a company. How can you use your equity to generate more income? And so, at Wellington, in some of our strategies, we actually use options within our equity portfolio to generate extra income. So we sell some of the upside optionality, and we generate income through option strategies. And so that's very consistent. You write a premium every month, every quarter over a specific stock, and you receive that option premium as income. And so that's a really differentiated way that is uncorrelated with traditional risk assets. The other aspect as well is looking at which companies have high quality earning streams that are stable, consistent, that are going to be able to pay me a healthy dividend, and those dividends are higher than what they were 12 or 18 months ago. It's about looking across your whole portfolio, and then again touching on this concept of fixed income. High quality fixed income today is paying you a reasonable amount of income and giving you the ballast from duration. So if you can get 5, 6, 7% from fixed income without having to buy, excessive amounts of non-investment grade debt, that's quite compelling in my opinion.
Mm-hmm. We've got a few questions about China. And so let's keep it, in relation to the US economy. So first question, China is easing in the COVID-19 zero policy. What impact do you think it will have on the US economy, in particular for unemployment? Would you say it's more positive or more negative?
Yeah, sure. So I'm happy to talk a little bit about China and then sort of, come to the back end of your question, because I think it's a highly topical one. When I think about sort of China and our discussions internally with our specialists in the region, the zero COVID policy in our eyes, the direction of travel is going to continue to be opening up. Mm-hmm. And so, when I think about sort of, how they're handling, some of the challenges with reopening, it's going to be volatile. We're going to see spikes in cases. We've seen that all across the globe. I think the rhetoric from the government has continued to be, fairly consistent, but it's also with the view that we're shifting in the right direction towards a more normalized economy. And the key thing I think to think about is not China opening up to the world, but China opening up to its domestic economy, being able to travel, into province, being able to go on holidays, and not just being stuck in your own city, whether it's Shanghai or wherever. And so, I do think, I'm more optimistic about the future for the Chinese economy, given a number of these factors and stuff. And so, if I think about consumption, if I think about the long-term policies that China wants to implement, all of this requires, their people being out and around and doing stuff. So, I think when I think about that relative to the US and unemployment rates, I think they're in very different positions. I think demand is going to come back extremely strong in the domestic economy. The one factor I would sort of question mark is just the ability for people to consume. In the US during COVID, you basically had helicopter money. Stimulus checks were mailed out to people. In the Chinese economy, we haven't had that. People are locked away at home and they haven't been able to work or earn an income. So that's one factor I think you do need to be cautious of. So when I think about employment, really employment I think is going to come back very strong in China. Unemployment in the US is going to tick up, but not to extremely high levels. If we go from 4 to 5%, I think that's a healthy level of long-term unemployment.
Mm-hmm. So next question about China. The valuation in China's companies looks attractive, but I'm really concerned about the risk of it. So what are your insights on which sector to focus on and which has growth potential for 2023?
Yeah, it's a great question, and it's a thoughtful one. When I think about sort of the Chinese economy, specifically around the Party Congress and some of the rhetoric that we've seen come out of that, I don't think the way you invest has changed meaningfully. It's more pronounced what you need to focus on, and what you really need to focus on is where there is alignment with long-term government policies and companies' ability to be meaningful innovators in their industry. If you have a company that's earning outsized economic profits and that company isn't aligned with government policies, take the education sector, for example, in 2020, that sector is going to be punished. And so you really have to have depth and understanding about, what is the long-term impact of this industry. And so I'll give you a couple of industries. I think, when I think about sort of the electric vehicle supply chain, China is a leading edge innovator in battery technology.
Mobility.
In future mobility. That's an area that's going to see continued demand onshore and offshore. Because another key policy for China is decarbonizing, their energy usage. So whether it's wind farm, renewable energy generation, another area of focused investment. The other factors I think that are interesting areas like healthcare. They've seen a number of areas of regulation. China wants to have first world leading edge biotechnology, biopharmaceutical companies. So another area that I think is quite interesting for investment. And then more broadly in terms of consumption demands, what they want to, they're still trying to shift from an economy of fixed asset investment to consumption driven. And again, it's what's aligned with common prosperity when it comes to consumption.
Mm-hmm. Thank you for those key points right there. Last two questions. So back to more general overview. In which year do you expect the irrational or speculative market to come back? Because I am quite concerned about this, and I would like to know your insights about this. I would also like to know how I can stay ahead of the curve and ride the craziness wave up.
Yeah, I feel like this is the $1 million question as well. Rational exuberance occurs in a number of different formats and in a number of different markets. I think the pendulum of markets have swung, with the level of uncertainty to greater pessimism right now. When we think about forward-looking returns, I think, when I think about what's occurring, when companies are trading at 100 times earnings or 200 or 300 times earnings that you're paying for growth, to break that down, that means that it's going to take 200 years to be repaid your initial investment before you generate a return. So I do think people need to think about, what is the cost of capital? What are they paying for growth in certain pockets of the market? And so what is the future growth of businesses? And be very cautious about that. And again, this really comes back to this idea of, we focus on free cash flow. What is the business generating today? Because free cash flow is very difficult to manipulate. People can be very creative with their accounting policies. If you're using things like EBITDA margins and other things where you can use depreciation and amortization. And so I think if you're focusing on businesses that are generating significant free cash flow, are growing that free cash flow organically from their core businesses, their core operations, they're not doing M&A, they're not doing fancy financial engineering to reinvent themselves and create a different level of PE that should be applied to their business model. That's what you want to look for. And so those are businesses that are participating in structural shifts. That could be the digitalization of the world. The one thing I would say when we think about, growing your earnings, you have a few different ways you can do it. You can cut your costs, you can go find new customers, or you can optimize your business. And, digitalizing, improving your efficiency is occurring in every aspect of the economy and companies. And so businesses that specialize in that are solution providers, I think are really important over the next decade. But again, be careful what you pay for that.
Yes, good point there. And also, thanks for covering both sides, the reality of right now and also that optimism going forward into the new year. So to end off, and I really like this question as an ending question, Jeremy, what are the major headwinds for the Singapore market besides inflation for the new year?
Yeah, it's a fair question. And when I think about the Singapore market specifically, I think I think one of the key areas we've all factored in is sort of the real estate market. We've seen a lot of influx of new people and our population dynamics changing and stuff. And so those factors on consumption habits, on real estate prices, I do think is a large portion of our index here, and so something we need to be conscious of.
Mm-hmm. Thank you so much, Jeremy, for answering all the live Q&A questions, and to the audience, thanks for being a part of the discussion. So, Jeremy, for the topic of today, what is that one line or summary point you'd like to leave the audience with today?
Yeah, it's a great question. And if I sort of reflect on what we've spoken about today, I think you mentioned the word. I think it's flexibility. I think it's prudent capital allocation and having flexibility and optionality in your portfolio. And so that's going to serve you well in the new year.
Mm-hmm. That was Jeremy Butterworth, investment strategist at Wellington Management. Thank you so much, Jeremy, for joining us today. And we look forward to the next show that we'll have with you.
Thank you so much for having me. It's been a pleasure.
Thank you. So the audience watching, we'll go into our last giveaway for today to reward you for being here with us. And also, I hope you've been listening to all the insights from Jeremy today. Okay. Top 5 fastest fingers first, and the right answer will walk away with something from us. In 3, 2, 1. Which of the following generated the strongest return in the third quarter of 2022? What do you think? A, S&P 500, B, the MSCI Japan, or the C, MCI Europe? The last two in USD. What do you think? Yes, you guys are very, very quick. Before I could even read out the potential answers. Congratulations to our top 5 winners. The teams will be in touch. Okay, that's all we have for today. Thank you once again for joining us for show 6 today. And of course, later on, we will continue the shows and we'll have more experts that you can talk to and have a chat with towards the end of the week, because this entire week we were covering, the potential opportunities as we wrap up 2022 and head into the new year. Now, to stay ahead and to also ask your questions, here is the email that I talked about just now. You can drop us an email right here, or if you have any more further questions, you can also just leave it down on the chat box down below. All right. So follow this page. Scan the QR code if you want to be, on top of the news and top of the analysis and some key sound bites that we pick up from every single show. We'll be posting all the insights right here on this page. So do follow us in the Moomoo app for this particular segment. And of course, we always have our main shows, edutainment content crafted just for you. Follow us on our social media pages because we're so active on there. All the updates, the live feed updates are all listed on our YouTube channel, our Telegram group, and also our Instagram. So if you want to just click through very, very fast into the show, always look at our stories and also our posts, because they're all about educational content, financial literacy to help you, to empower you in helping you make a better investment decision. And of course, World Cup, we talked about it just now. We've also got a campaign running right now. So if you're interested in getting some rewards from this and also investing as part of, these times, it's not just about the campaign. It's about, being a part of that fighting against inflation times and rising rates environment with you. So it's always about crafting things for you and with you. And I hope you join us as well in this. And so with that, thank you so much for joining us again. Show 6 today. We're going into the next show happening in about 50 minutes right here, back here. We're going into integrating the world of sustainable businesses into your investment. So I hope to see you later on in 50 minutes. Once again, I'm Olivia Higgins, and I'll see you later. Bye.